Hello, and welcome to the Physical Therapy Owners Club podcast. I'm Nathan Shields, and longtime guest, friend, multi-time platinum artist, whatever.
There you go.
Do you want to give him? Eric Miller joined
Academy Award winner. All right.
There you go. Yes. One of the best bald heads in the business.
1984 knee football champion in Toledo, Ohio, right? You ever played knee football when you were a kid? That was me, right?
Nice. Yeah. All the accolades, man. Way to go. Right. We're good to have you back, Eric. Thanks for joining
me, buddy. Good to see you again.
Cool. Well, like we've said right before we're pushing the button, we were talking about, talked a lot about, okay, you have this cash flow crunch or handle this kind of financial issue. This is how you hold your accountant accountable. Many different issues that we talked about financially regards to physical therapy ownership. But today we wanted to look a little bit more on the positive side of things and say, okay, now you're making some money, or you're in a situation where your clinic is doing well and you have a lot of cash sitting there. Now what do you do? So I'm excited about this conversation because...
Me too, because I'm so tired of talking with physical therapists and it's always just we don't have any money, our profit margins are crap, it's why can't we just reverse this and in the bizarro world and say, what happens if you guys have $500,000 sitting in your business checking accounts, and what do I start doing with some of this? That's much more fun.
Well, we've always hammered home the idea of the 10% set aside, right?
Yeah.
So 10% of gross revenues goes to a designated bank account that you do not touch and is meant for a future investment, right? Or for your future, right? But we never talked about what to do after you set it aside.
Yeah, for sure. Yeah.
Right. And then there's also opportunity, how you set up for investing in future expansion, growth, opportunities, that kind of stuff. And so that's also the fun stuff. So I'm excited to talk about this and forget about the fact that we have crappy profit margins and that there could be cash flow crunches. Let's look at it like this is a sunny day with rainbows, butterflies, and roses all around us.
Yeah, that's much better. Yeah, it's really how it should be.
Yeah.
And I think and you know what? There are probably a lot of people that are getting close to that point where, they are going to start seeing significant amounts of money now coming in because there, gets to a point where, you're getting to a capacity level in your practice where now money's coming in. You kind of, all your fixed expenses are fixed. And now, as you see more patients over and above a certain threshold, you're going to start seeing a lot more money. And that's the way it should be. So now it's what the hell do I do with all of it?
Right. So you should stock it all away into the stock market, right?
It's game over. Podcast over. We can stop.
Are you done? Do you want to share your contact information now?
That's probably not what I would do, but it's not, but I will say this. Public securities, which obviously is, I think, kind of wealth management, stock market investing, investing in, individual stocks, bonds, mutual funds, ETFs, certainly is a strategy as part of what to do with your money that we certainly look at,
Right.
It's just not, it seems like in our industry, at least the experience I've had with a lot of, owners is that's where the majority of their investments go. It either goes into mutual funds or, some kind of retirement account that invests in mutual funds. And nothing is even mentioned other than that.
Right.
So we're certainly not anti-stock market. I just think right now, to me, as we talked about, when you're starting to take your profits and you have your wealth storage account, let's start dollar cost averaging into the markets right now.
Yeah. Don't just dump $200,000 at one moment into the stock market.
No. I've seen that happen though, because, over the last 5 years, a lot of people sold their business, right? And I've seen a lot of owners get millions of dollars and then they just go to what their guys told them to do for the last 20 years with their other investments. And then they just put it all into, wealth management, public securities. And then markets were down, 20% last year? That's kind of terrifying to do. So you really got to manage the risk a little bit. But that being said, I would, as you have profits, as we put them in that account, I would definitely, start dollar cost averaging into an intelligent mix of, either dividend paying stocks, municipal bonds. T-bills right now are paying 5%, which is more than what you're going to get on, a checking account. Mm-hmm. So from a cash management standpoint, I would, we definitely look at public securities as a part of that bucket as well.
How do you approach this for private practice owners without overwhelming them? Right. So they still have a lot of time set aside for managing the business, and they still want to spend time with their family. Yet we're going to tell them about all these different options. Yet to some regard, they have to spend time managing those things unless they pick the ones that are more passive per se.
Yeah, I think part of my job as an advisor is to kind of like look at the big picture and say, this is how much we're going to allocate into public securities. And this is the kind of mix that we're going to use based upon everything else you got going on right now. Right. So I don't know that they have to do, obviously we would educate them. This is what a T-bill is. This is what a municipal bond is. This is what this kind of, dividend paying stock strategy would be. And then from there, we just say, this is how much of your money is going into this allocation right here and why, Mm-hmm. And I think from there that they don't have to do the work of rebalancing and reallocating and those things. Typically someone like in my industry would help them with that.
I got two questions. What percentage of the owners really want to be involved in their investments, would you say?
I'm trying to get more of them to take a partake in this because, we got to get them off their practitioner hat and they're thinking about the owner investor hat a little bit more.
In their future. Right?
Yeah. So I would say, oh gosh, maybe 20% start thinking that way.
Like 10, 20% want to take an active role. And I do want to take an active role as well. I just don't know what's out there. And what I fear is that most advisors, and correct me if I'm wrong, you're in the space, so you probably know, but most advisors are going to have these pre-planned packages.
Yeah.
This age, this is your goal. This is your number, right? That's the common attack. And so this is the stock portfolio that you're going to be in.
This is the mix of how much you should have and based upon your age. And the flaw in that, obviously, is that they're not looking at everything else that you own, and that's a flaw because they're just looking at one portfolio and not looking at in the fact that, well, my gosh, he's got a business that's doing $2.5 million a year in revenue, and he's got a building and he's got this much debt, and, they already have these other investments as well. And, and also maybe he likes doing real estate, and he's good at it. So why would I pigeonhole someone into just like a static cookie cutter portfolio when that's not really what he needs, because I'm looking at every asset of his household, not just that one portfolio. So again, it is a problem, and it happens to a lot of owners that they get caught up in that. And that's how that advisor gets paid as well. So that's, they're going to have a slant towards where they get compensated as well.
So say an owner has, let's say $100,000 at their disposal to invest. Maybe they own the clinic in which they're the real estate of the clinic. In which
it should be great. It should be a great investment to get. That's another income source. If you can own the building. Yeah. I think most
go that way, right?
Yeah. I think most people kind of inherently know that they should, but, it's not always easy to do. But yeah, you definitely should get the building if you can.
Right. So maybe they own that, and maybe they want to do more investing, and they want to cover their tracks. Of that $100,000 that they're wanting to invest, say they're in their 50s, maybe 60s, a little bit older. I'm almost asking you for a cookie cutter approach, but I know that's not where we should be going, right?
Ah.
But I think just to give the example, you wouldn't recommend people take that $100,000 and just turn it over to a mutual fund, some kind
No.
of pre-tax plan, right? How would you recommend maybe breaking that up? Is that a bad question to ask? I don't know if I'm going the right way with that.
No, I think it's right. I think, let's say that practice is going well. I've been able to now accumulate $100,000 in my wealth storage account, my profit account, right?
Right.
Okay. And I'm continuing to put money in there, right? Now I have 100,000. Okay, great.
And your rainy day fund is set aside.
Your rainy day funds are good, and now we can
taxes set aside. Those are all good and accounted.
Everything else is paid up. Now we can start investing. So,
right.
Typically we'll set up third going into, like what I said, public securities, a third of that going into some insurance-based products, and a third going into some kind of a real estate. Now that's
okay.
That is the allocation that we'll typically do. But let's say, like I'll take you as an example because you love real estate, right? Mm-hmm. And so we would probably say, well, you like real estate. You want to maybe it's 50% of that money goes into real estate, and the other
part towards like a down payment of another purchase in the future.
Yeah, exactly. And then we'll carve out maybe 20% in insurance-based products, and then keep the rest of it in some kind of public security, just dollar cost averaging in some kind of a portfolio like that. So
gotcha.
So keep it simple, but obviously kind of formulate it for what the person has an affinity for. Like, what is it that they like to invest, or maybe they know, certain types of, real estate that they really like and that they want to buy,
Right.
So that's the approach that we would typically take when it comes.
As you're looking at that approach, are there some that you lean more heavily towards because there are tax advantages for them? Because there's an understanding here. We shouldn't have to say it, but we will. You're going to want to at least max out your 401k contributions, Roth IRAs for sure. I'm sure there's safe harbor funds that you want to make sure that you can sock away money for if you have that kind of plan set up in your company. That's an understood.
I would just kind of assume that most people already have some kind of qualified plan set up through their business as a benefit for themselves and the employees, a 401k plan. And I would encourage most people to, from either a tax perspective or, creating tax-free income, like you mentioned, the Roth, to continue to do that, right? Then that usually comes through your payroll. That usually comes through your salary. So that's one component. We're talking about your owner pay, right? Which is, for most physical therapists, is going to come in the form of profit distributions out of the business, which isn't going to go into your retirement plans. Okay. So that being said, that's what we're talking about that.
Can I ask you really quick, and yes, we are talking about that profit account, but really quickly, inside those plans, like the 401ks, your thoughts really quickly on self-directed IRAs and how to best utilize them if you're good with them.
So self-directed IRAs are basically the ability for you to invest in, I think, alternative investments. I think that, again, if you really like these alternative investments, you understand them, then you can find and move some of your money over to these self-directed IRA platforms and do that. I mean, I think you increase the risk a little bit because they are alternative investments, and nothing's guaranteed. But if you understand it, I don't have really any issues with that, as long as
because correct me if I'm wrong, but most IRA plans, they're going to limit you to certain purchases of stocks and bonds and that kind of stuff.
Correct.
What you can't do in a traditional plan under a traditional warehouse is invest in, well, I'm sure you could do gold as well, but cryptos or real estate.
And real estate,
real estate with your self-directed IRA funds, as long as you don't personally own the real estate, you can do short-term lending. You can put into real estate funds, that kind of stuff.
There's definitely restrictions on what you can, what you can't buy, and but I don't see any issue with it. Again, as long as it's not 100% of your retirement portfolio of your,
and as long as you know what you're doing, you're not turning your money over saying, "Oh, I hope that goes well." I mean, you've had the time to assess it, inspect it, do your
one would think that that's what you would want to do. People get sold pretty easy on something that Oh, 12% return? Great. Where's that? Oh,
Sign
what
me.
does it invest in? I don't care. So just give me the 12% return, right?
Right, exactly. I just wanted to talk about self-directed IRAs. They are for some people. This is maybe for the
Yes.
10 or to 20% of you out there that want to take a more active approach to your
Yeah.
investing, right? So you got broken down into thirds, this $100,000, stocks, bonds, mutual funds, T-bills, you name it, right? That's where you talk to a financial advisor like yourself.
Yep.
What do you recommend? What's the safest bet with the highest return? All that kind of stuff. Here's what those things are. The other third, insurance vehicles.
Yeah.
Talk to us a little bit about insurance vehicles, because you're going to hear plenty of people out there who are just like, don't worry about the whole lives and the universals and all that kind of stuff and the cash. Why would you recommend a third going into the insurance vehicles that you're describing?
Yeah. So you look at insurance-based vehicles, because the insurance as financial institutions, have traditionally been some of the most dependable financial institutions out there. They're much safer than banks, which most people probably don't realize that. And they don't have any risk of investment loss like stocks and bonds do, okay? Because insurance-based products have guarantees around them. The whole purpose of putting money in insurance-based products is that you're looking for really two things. I want to create a pool of guarantee of money that come to be guaranteed. They pay guaranteed income, right? And in some cases, you can create tax benefits, tax advantaged income for yourself as well through the use of, a properly structured cash value life insurance policy.
Right.
So unfortunately, the insurance industry is a sales industry to a very high degree, and a lot of these products get sold incorrectly to people, or they think that they're going to get these huge magical returns, and that's just not what they're designed for. It's designed for the protection. Think of what an insurance company does is they transfer risk, right? So what risk am I trying to handle with putting money into an insurance company? Not outliving my money, so I get guaranteed income and getting some tax benefits as well. That's all we use them for. Okay, so we carve out that portion in there because I still want people to have, I'm not sold that pension benefits that we have, Social Security, are going to be around forever, or they're going to be cut for people that have means. So we have to kind of create our own little pension. And the way to do that is through the use of annuities and cash value life insurance. That's the only reason. It's not for the rates of return, believe me, but they have certain benefits and embedded bonuses and things they can do that other institutions can't do. And they've historically, during times of depressions and recessions, you don't see insurance companies go belly up and bankrupt like Bear Stearns or banks and all those things do.
Well, especially as you're older, a benefit of those annuities is if there is a crash in the market, you're not going to lose money in a traditional annuity, right?
Yeah, in a traditional fixed index annuity, they have principal guarantees around them, and you won't lose a penny
Right.
based upon there's obviously the risk that the insurance company goes default, but they don't over leverage. They don't go out there and lend to subprime. They have to operate differently. That's all. And a lot of people don't really know that about insurance companies. They just hear all the bad things that all the kind of the gurus say, like, oh, a rip off and just huge commissions. And, I am sure that happens. But again, if you structure them correctly, if you utilize them for a purpose, then you usually get a pretty good outcome.
So tell me a little bit about the insurance vehicle that you shared with our mastermind group when we went to Montana. You talked about the insurance vehicle that you can use to loan yourself money, purchase equipment. That balance is still maintained in the insurance policy. Talk to me a little bit about that. That's a newer concept for me, and I think I understand, but that might be completely new for some people, because I know one member of our group was advised to do that from a very early stage of his ownership. And then after we hung up on the call with you, he's like, yeah, I used that policy to go buy a boat and paid the policy back instead of paying the boat company back. Maybe that's not the best usage of it, but you can loan money to yourself for maybe personal and professional usages.
Yeah, for the most part, it was something that I learned early on when I first started working with PTs. And, we started looking at, okay, I need a place for them to store money. I want to make it difficult for them to like think they can just go in and grab it. But I also know that I want them to be able to utilize this money in case that they get into a jam, or they want to invest in something else like a building, or they want to invest, in some other kind of vehicle. And I know that they need insurance, and I know that, so it kind of, helped a lot of these different problems that we were trying to solve. Now, cash value life insurance, permanent life insurance has been around for hundreds of years, and it typically, it started off as whole life, and then they created universal life. And those are the two basic types. And neither one of them, I think, is either bad or better. It's just different. And it's, again, it really is the design of the policy. But for most people, you put money into this policy, it builds cash value.
And what's again that you can loan yourself out? What's that one called?
Well, that's just a mechanism of that kind of policy.
Okay.
It's just a
you can have a different policy, and just as long as you have that capacity.
Yeah. And as long as there's a cash value component to the policy,
there it is.
And the cash is building inside the policy, and it's structured correctly, and the person's funding it correctly,
right,
then that will start to accumulate sizable money. And, I got one owner that's been doing it for like the last 15 years. He got $2 million of cash value, right? And now he's going to use it to go buy a business. And he'll write a check, right?
And pay cash for it.
Yeah, pay cash for the business.
And interest rates, I'll just pay cash. Thank you.
The interest rate on the loan is 4.6%. Try go getting a loan right now for 4.6%. You're not going to find it. Okay. Yeah. So basically what you're doing is you're going to the insurance company and saying, I want a loan, right? And they look at your policy and say, well, great, the money's there for collateral against that loan, right? And that's all it is. So the money still stays in your policy earning interest, but now you have a loan with the insurance company, right? Where they charge you for, interest, but the interest kind of washes out. But, you don't have to pay the loan back like over like a time frame.
There's not a term.
There's not a term. You can pay back whenever you want to. And if you don't, all that happens is that whatever the balance of the loan is gets deducted from the death benefit when you die.
No.
So it's just a tool, right? But it's kind of cool. And if you're a young owner listening to this, like of course, young owner, what does that mean? I'd say if you're 20s, 30s, and 40s, and early 50s, it works. You start getting in the mid 50s and over, probably not.
A lot of time left.
Yeah, we need some time. We need some time to be able to like utilize it. But if you're in that age range, and you set something up, it's pretty cool. I did a lot of that for a lot of owners over the last 15 years.
Maybe the owner that's been doing it for 15 years is a good example, but to take advantage of a plan like that, or what are you talking, $10,000, $15,000 a year or more?
Oh no, he put hundreds of thousands of dollars into it.
He was just socking it away.
Yeah, it really had a successful practice. Well, you can build it for whatever you want to. You
have to do minimums though, right?
There's a minimum based upon the size of the policy, but you can build it for any kind of $40,000, $50,000 a year, $80,000 a year, $20,000 a year. You can build it however you want to. But
so you're looking at that money, not like this is going to net me 8 to 12% for the rest of my life. That's not how you're approaching this vehicle. You're approaching it like, this is money that I'm putting away for an opportunity in the future that could be 5, 10, 15, 20 years.
It's a storage place for money that keeps it protected, that doesn't allow it to get lost. And if they didn't do anything with it, it would convert into a guaranteed tax-free income source for them at some point in time.
At a certain age, like
yeah.
Oh, that's cool.
You can convert it to, some kind of a guaranteed tax-free income source. So it just has some pretty cool benefits. There's a cost to it though. The downside, of course, is that most of the expenses of the policy are absorbed in the first 10 years. So it's a commitment, right? But after 10 years, the expenses start to draw are very minimal and it gets good. But like there's just no perfect thing, but this is why the design and the application is so important.
Yeah,
exactly. And it's not just, I'm going to go buy this policy, so I would caution people, just don't go out and try to do this on your own. It's got to be part of an overall strategy of what you're going to be doing with your money.
Right. I love this conversation because I want to expose people to, hey, stocks and bonds aren't the end all be all.
They're not the end all be all.
And any advisor that says that, and that's all they present to you, is really short-sighted, not doing their full.
They just have a bias, and maybe they had a bad experience. Maybe their grandma, got sold a policy and it, incorrectly or whatever. I mean, there's bad investment stories all over the place, but there's a lot of good ones too that you just never hear about, especially in the insurance industry.
Yeah. And so when you're talking about that third aspect, the other third of that $100,000 that someone has, you talked about real estate specifically. Before we get into real estate, if someone said, I need to put something in crypto, or I need to do that now. How much of that $100,000 would you ask them to limit that investment to?
Probably like 2 or 3%, somewhere around there.
Okay.
No, I'm just looking at what.
That's honest.
Yeah, not much. I'm still ambivalent about crypto. I'm just looking at what Bitcoin's that's at about. Yeah, it's down to 25,000 right now, and that's a speculative play.
It is, and
yeah,
I would just say, and this is my personal opinion, anything over 10% of that $100,000, 10% of your investments in any speculative play is just too much.
Let's put the 5% in crypto and gold and silver. All right. So we're kind of using the old school insurance of gold and silver and the new school of maybe Bitcoin. I'm okay with that.
Okay.
I'm okay with that. Yeah.
All right. So then in regards to real estate, we already mentioned owning your facility is going to be the best bet, right?
That'd be awesome.
You're betting on yourself, and you're putting some faith in the possibilities of growth. And obviously you're going to be looking for areas that are going to appreciate. You get the tax deductions.
Yeah.
Of course you can do, why do you say a third of it real estate outside of just owning your practice?
Well, because I think that real estate is especially for an owner that's starting to make a lot of money, I'm going to need some potential tax benefits as well, some tax strategies as well. And, if you can acquire some properties on your own, rental properties, maybe you can use the depreciation or accelerate depreciation to help offset some, income that you're making on in other areas. So it could be a significant tax benefit for you as well for doing that. So that'd be one reason. And, I guess real estate in general has been, depending on how you do it, is going to be important as well. I mean, are you going to go buy the properties yourself individually owned? Or are you going to do it with a partnership, or are you going to invest in like, we can talk about that, like a private placement deal?
Yeah, because some people are going to say, well, I don't know how to be a landlord. I don't know if I want to be a landlord. I don't want to pay for a property manager to do the simple thing of collecting rent and paying the taxes. Which is what I would recommend. It just takes it off your plate. If you want to make that play, let a property manager do it first, so you don't have to deal with the issues and get the calls on the weekends. But so if they're saying, I don't want to own it myself, I'm still a little bit hesitant about it. What are some of the private placement options that someone could take advantage of? And could they still get tax advantages from being in private placement situations?
Yeah, sure. I mean, the private placements are basically, I guess, separate types of investments that are for what are called accredited investors. Mm-hmm. So, and most owners would be accredited investors. If you own a business, that's halfway successful, then, you're going to be an accredited investor based on your net worth.
What is that? Assets over?
I think it's assets over $1 million, excluding the house, or you make $200,000 a year in income. So it's not
you are an accredited investor.
You'd be considered an accredited investor, right?
Right.
And most of these private placement deals have to have that verified by a CPA or an advisor. that you are an accredited investor.
And what are private placement investments? What are some of the names? Because I don't know if everyone would recognize what private placement means.
Probably won't recognize some of the names on there, but they would be, I mean, right now, like real estate, there's operators out there that specialize in maybe certain types of real estate. Okay. So there's a lot of operators, and they're called syndications. Mm-hmm. So you have, people that are really good at investing in apartment complexes. So they create a fund, right? It's not a mutual fund. It's kind of like it, but it's not. And you act as a limited partner, and then they are the general partner. So you invest as a limited partner, and they'll typically have a schedule of how they're going to pay you, some kind of a preferred return, maybe 5 to 7 to 8%. And then their goal is to, buy properties, fix them up, get them rented, and then at some point and sell them or refinance it and then pay all the investors back.
Right.
And, and it sounds easy, but that's what they do. And I guess for me, if you're going to do, and that's a great way to invest. I mean, if you always wanted to invest in apartment complexes, but you didn't want to do the work, go to someone that money. Yeah. Go to someone that knows how to do it. Right. Now you're most likely going to need about a $50,000 minimum investment to do something like that. Your money is not liquid. You can't ask them the next day, can I get my money back? I mean, they may or may not give it to you, but in most cases they probably won't. So, and then they do a lot of and the tax benefits would filter through you as a limited partner.
So you could still get the depreciation as a syndicate partner.
You get that on the money that they're paying you. You couldn't, so that would filter. Yeah, you'll get the depreciation that, that would affect whatever dividends they're paying you. Mm-hmm. But yeah, so, but I think for people that don't want to get in, still want to own real estate, but don't want to get involved in the management or anything like that, that's a pretty good way to go. You just have to really trust the operator, because there was a group not too long ago that just went bankrupt that had a lot of investor money, and, people lost on that.
Well, I lost a chunk of change on a group like that before as well. Trusting my financial advisor.
You really,
that was like 2008, 2009. So
that wasn't me, by the way, folks. So, I think you really got to just know what the operator, and understand what the kind of real estate is. Like I've talked to you before. I mean, I do the self-storage thing just because I tend to understand that the most. And it's like, I understand that. And then I just find an operator that I trust that knows how to do it really, really well. Yeah. And there's guys that do, mobile home parks and apartment complexes and all kinds of real estate out there. So right. I like that. I think that's good for most people.
And I don't want to promise anything, but a typical investor in some of those private placement, whether it's funds or syndications, they're expecting 20% returns over the course of the life of the fund.
Yeah, I did one, I think, in 2019. Now look, we were in a low interest rate market. I mean, I put $50,000 in. They sold 18 months later, and I think I made like 60%. Yeah. Right. So over a 2-year period, that's like 30%, somewhere around there.
Right.
Now, I mean, obviously I'm not expecting that, but if they get you 12 to 15% returns, I think I'm happy with that.
Great. And these aren't guaranteed. So
no, they're not
talking about this. These aren't guaranteed. They are greater returns because they are riskier placements of your money.
Yeah.
So you have to understand that. However, like you said, if you can trust the person that you're investing in, you're essentially investing in a group that's going to, in some version or way, correct me if I'm wrong, do a fix and flip. Like what on a residential house, like you see on all those shows. But they're doing this at larger scales with self-storage facilities, mobile home parks, RV parks, multi-family units, right? If you can trust them and they show a track record, they're going to have an offering memorandum or some kind of investment memorandum that says this is why we picked this area in this city, in this state. this is what's happened around them. This is what we've done in the past. So you can look at some of these things and hopefully trust in them, and maybe talk to a couple of the other investors as well.
It's the number one.
You can generate some good returns.
There's no doubt. It's the number one thing, though, is that the operator is how you make your money. That's it. Yeah. It's who's operating this thing. It's not too dissimilar to, these corporations that are buying physical therapy practices. I mean, they're trying to do the same thing, right? Fix them up, and then we're going to flip them at some point, Josh.
Yeah, exactly.
Right. To be the game.
Last question about real estate. If you had that $100,000 and someone does own their real estate and they still have a $500,000 note on it, would you ever recommend them just dropping the $100,000 into the balance owed
on their building? Yeah. No. I would, almost 90% of the time I would say no. We'll use it because as long as the building is providing a pretty good cash flow, and it's, maybe we pay off the building when you sell. Maybe we'll pay it off at that point in time, because then you just get all the income from the rent. And that's typically what we've done with most people. And even then I'm still like, is that the best use of the money? And I'm like, probably it is, because it gives them ultimate freedom, because now they get, they're getting $10,000, $15,000, $20,000 a month in rent, and that more than pays for their lifestyle, and they're happy, and they're happy with that.
That was a huge benefit when we sold, was owning some of the real estate in which we practiced out of, and then signing the leases with the company that purchased us. I'm like, oh, now I got not only did I cash out, now I have an income stream coming from the ownership of that. And then the opportunities, if you've ever read Rich Dad, Poor Dad, this is what he talks about when leveling up, is you can eventually sell that asset, buy a bigger asset that cash flows better.
Yep.
You do take on some more leverage, but like you said, there are some tax advantages of counting that depreciation against your taxes. So there's opportunities to grow and build a real estate portfolio over time, should you do that.
Absolutely.
Yeah. Well, any other thoughts regarding investment strategies for practice owners that we haven't talked about?
Man, I think we covered quite a lot. There's definitely a lot of other private deals you can do. I mean, you can do hard money lending too in some of these deals. You can lend your money to groups that lend money to private equity groups. I mean, there's not a limit to on the private side of what you can do as long as you're an accredited investor, but you just have to understand that game. And a lot of people are just like, well, I don't know, but you don't need to. But I think the most important thing is just setting up the strategy so that you can't do this if your practice isn't profitable. None of this works if you can't get your practice profits out of the business.
Right.
Sorry.
Well, it goes back to one of our previous podcast episodes where you said you've got to demand the profit.
Yeah.
I loved how you said it. You've got to demand profit from your business. That's why you have it. If you have it just as a service to the community, well, yeah, this conversation's worthless to you. You got to demand that profit.
You have to. Yep. And the best way to do that is to put it in like an expense and treat it like an expense. And from a money perspective, and it will be there.
Right. And if I know I've made the recommendation before, but if you haven't read Profit First by Mike Michalowicz, he can talk you through that.
Yeah.
If you wanted to summarize the book, set aside 10% of your gross revenues on a regular basis, weekly, biweekly, monthly, whatever you want to do. And if 10% seems like too much, start at 1 or 2%, 3%, whatever you can swallow, and gradually build up over time until that expense line becomes 10% of your gross revenues going towards one of these vehicles that we're talking about.
Exactly. Yeah. If you can just start on a gradient and build up to that point, the business will eventually cover it to make it, as long as you're doing things that are allowing that to happen and not crying because they just cut your reimbursements again. We got to figure this out. Right. Everyone can do it.
You can do it. We can do it.
There's no crying in physical therapy.
Yeah, we can't cry because we're making a lot of patients cry. It's not fair if we try to do the same. So if people want to talk to you about some of these investments that we talked about today, how do they get in touch with you?
Hell, they can just go to wealthforpracticeowners.com. I think we have a landing page there. Or you can just go to econologics.com and we have all kinds of downloads and you can connect us that way as well.
Are you on the socials media?
I mean, yeah. You're asking me where to go on that.
Well, if you know, are you on LinkedIn if people wanted to reach?
We're definitely on LinkedIn. Yeah, I'm on LinkedIn.
And you're in the Facebook Owners Club. Facebook physical.
Yeah, you can always reach out to me in the Facebook group as well on Messenger, through the Facebook club as well.
Cool. Awesome. Well, thanks for your time today, Matt. It was fun to talk about how to use all of our money.
That was fun. That was really fun. Guys, it is possible. They can actually do that. These are the fun conversations to have.
Right. Exactly. Thanks, man.
All right, buddy.